Hi guys, Gino, Sam. I'd like to welcome everyone to the FXTG educational webinar. Welcome to the world of Forex with myself, Roczniak. General advice disclaimer. This presentation is aimed to be educational and in nature and should not be solely relied upon as a recommendation or invitation to enter into a particular transaction or to apply to a particular trading strategy. You should not engage in trading unless you understand the nature of the relevant markets, the rules and application of those rules to the strategy or strategies that you are trading, the products and the full extent of your exposure or to risk or financial loss. If you are in doubt, you should seek professional advice. 1. The advice contained in our site has been prepared without taking account of the objectives, financial situations or needs of any particular client. And because of that, the client should, before acting on advice, consider the appropriateness of advice having regard to the client's objectives, financial situation and needs. And also, you should know that FXTG clients are required to read all product disclosure statements. There's 3 in total. Welcome, and why you should listen to me. Number 1, I'm a highly regarded Forex trader, trading coach, and a Forex fund manager living in Australia. I have over 15 years experience in trading of all different financial markets, Forex, CFDs, stocks, warrants, binary options, etc. My hands-on experience helped me to utilize simple and effective strategies to make money for my clients and investors. And my passion for trading in the markets has been my career, and the knowledge can help you become a successful trader. Today's topic is going to be, we're going to be talking about indicators, moving averages. Basically, what is a moving average and how you can trade it. Okay, a moving average is one of the most widely used and versatile technical tools. I'm using MA as in moving average. So MA is a trend following indicator, so it lags market action and gives trading signals after a trend is already in place. MA is simply an average value of a price over a period of time. As the price changes, its average price moves up and down. The primary purpose of MA is to determine when an old trend has ended and a new trend has begun. An average is used because it's a smoothing device and makes it much easier to view an underlying trend. This indicator usually calculates the average of the closing price of the bar, since it's the most important price of each bar. And there are 2 basic types of moving averages, simple and exponential. Can anyone hear me? Can everyone just reply yes or no? Ari, yes. All good, Gino? Thank you. No worries, we shall keep on going. I'll be reading a few things, and then after we get into the MetaTrader, I'm going to actually show you examples. Okay, simple moving average. So a SMA applied to an equal weight to each price bar. In other words, each bar is applied evenly to show the line. And exponential moving average is an EMA that gives greater weight to the most recent data and some weight to the older data. And therefore, all the data in the life of the currency is used in calculation of that line. Now, how to use the moving average to generate buy and sell signals? The easiest way to generate buy and sell signals using moving average is when the price crosses above or below the moving average. A buy signal is generated when a currency price rises above its moving average, and a sell signal is generated when currency price falls below its moving average. The most followed MAs are in the 20, 50 and 200. Therefore, they are the most significant moving averages. Now, the longer the average is used, the less false signals you'll get, but you'll miss out on most of the price action. In other words, you miss out on most of the trend if you use a longer, higher moving average. And the shorter average is used more, it gets more false signals, but you're getting an early signal. So you got to really justify which one you're going to use. The best way to use the moving average to trade is to use maybe 2 or 3 moving averages, and I'll show you that in a moment. Entry and exits are generated when the price crosses the moving average and moving average cross each other. Now I'll leave this thing and I'll switch over to the MetaTrader, and I'll start from a new window. Euro USD. Just clean this up a little bit. Properties. Get rid of the ask, get rid of the grid. Okay, change it into candlesticks. Make this slightly bigger. And move this over. Everyone can see the screen properly? Okay, guys, I've got your microphones on as well, so if you can clearly talk to me as well. Okay, now to put on a moving average is obviously a trend, so you can look under the trend, moving average, and you put it on. So let's build up a moving average. We can put one at 20, and we'll make that one a red one, and the thickness, and there's the 20 moving average. As you can see, using one moving average, it's going to be a lot harder to get in and out. To give you an example, looking in here, basically your entry would be as a close above the moving average, but then you would have got knocked out because it closed back down. That's why they say that using one moving average will not really help you with your trading, as you're going to keep on being stopped out. So one moving average is not a good idea to trade just simply by using one moving average. Therefore, applying a second moving average, let's just say a 51, we'll change the color of this one to yellow for this exercise. This will more likely give you a better overview of not getting stopped out. So when the two moving averages cross over and the price crosses above it, which is basically like in here, right at this point here, there will be your clear entry to go and for a buy. And you use the closest, lowest point as your stop loss, which will be right here. And this would have kept you in the trade if you go on in here, even though it turned against you a little bit here, it stopped at the higher moving average and kept you in the trade, and therefore you would have kept on sitting in this trade here. Let's look back for an example. Another example would be, okay, we've got the right here where they crossed over, a buy would be here, and you would have jumped into the trade looking from right at this point. Again, setting your stop loss below the yellow line, and you'd have continued to stay in the trade until a bar closed either under the 20 moving average or continue until it's closed off here. Now, what I tend to do if I was to trade using moving averages, I actually introduce the third moving average. And the third moving average, oops, we'll put it here, we'll put down the 200, oops, 200, and we'll make it a blue one, so we'll keep them all separate. And there we go. Basically, this is the long-term moving average. Now, what happens with this? If the price is above the 200, I would only do buys. In other words, anything like in here where it's closing down to go to sell, I would actually stay out of this. I would only enter a trade on when, obviously like in here, it crossed over the 50 moving average, and they both crossed over here. I would have entered into the trade when the price penetrated the 200. In other words, I would set the buy right in here, and I would have continued with getting into this trade, and I would have exited at the very first moving average of 20. So basically from here to here. Again, I would have stayed out of the trade till the price came back up again above the red and the yellow, which is the 20 and the 50. I would have entered here again, only a buy, and I would have stayed in either until it hit the red again, or I would have used the 50 moving average to stay in the trade, and I would have exited when it crossed over here. So this is a sort of a choice that you got to make, whether to use the yellow one as a support or stop loss level. Okay, in here obviously you had the crossover here and the price penetrated here. So my entry, being that both of them already turned and going down, I would have entered it straight under the moving average 200 and continued being in this trade until it closed above the moving average 20, or in some cases, if you wanted to take a little bit of a risk just in case it's going to go down further, exit it right here. Either way, you would still make profit from here to here or from here to here. And again, I wouldn't get into this trade again until there was a full penetration of those two crosses. You wouldn't have entered it here because now it's showing that the moving average 20 is actually going up, so you wouldn't have jumped into that trade here. And again, obviously, you got the yellow pointing up, you got the 50 and the 20 pointing up. As the price closed above the 200, you know you're safe to get in now, and you'll be staying in this trade right from here, and you'll still be in this trade right now. Trying to see if there's anything more in here to give you good examples. Maybe I'll look at a 15-minute chart. We'll probably show a few more. Okay, we had a look at, I think it was that one before. Again, both of them pointing down, crossed each other, price crossed over the 200, therefore it's a sure thing. You're jumping in somewhere along here, you continue being into the trade until you either hit the 20 or the 50 line. Or basically, if you know there's been a strong fall, usually the market falls through all the way, you can basically stay in a trade until it basically crosses back over the blue 200 line, which, I mean, this is a clean and beautiful trade. It will not always happen that way. Being an example, if you did the same thing in here where both of them turned up, this one already crossed each other, they crossed each other here. If you come into this trade and you didn't get out until the blue, well, you probably would have been equal or maybe have a little small loss. But like I said, it's always better to take your profits earlier and maybe close down half of your trade and let the rest happen whichever way it goes. Now, that's about all I can show you about the moving averages. If you guys contact me on my email at FXTG, I might be able to actually show you send you a system on a PDF, actually how to trade this exactly. This video also will be available to be watched again over and over on our FXTG YouTube channel, and most likely on the FXTG Facebook page. Now, a lot of people use the 20, the 50, 200 really this is up to your liking. I tend to more or less stick with the Fibonacci numbers, so instead of using a 20, I would actually probably use a 21. With the 50, obviously being another close to Fibonacci number, which is a 54. And the 200, I tend to again stick to Fibonacci numbers, which is 233. But that's me. Everyone's different. So you can basically see how each moving average fits your criteria, because you might vary between, let's just say, a 5-minute or 15-minute. You can always play around. There's no set rule that you have to use a moving average 20 or moving average 50 or moving average 200. This is up to your own discretion. Like I said, if you just go by the 200, yes, you know, for this trade, yes, it did work out. Right here, if you were to enter, you will probably lost money on this trade. Same here, if you use the blue one, you'll have jumped in and closed below, you'll have most likely lost money. So that's why you cannot rely on using one moving average. You've got to use two at least, or three to have a confirmation of being right. Now, I have got you guys your microphones on. Feel free to talk to me if you have any questions. Do you know what is the fair target for this? I tend to use trade off the 50-minute charts and sometimes 1 hour. Basically, when you enter a trade, I would try to at least, whatever my stop loss is, to get the double, at least 1-to-1 or 2-to-1. In other words, if I was entering it here, right at this point here on this day, and let's have a look. So I would put my stop loss just about maybe 5 or 10 pips below the low. So if we look at the entry, and we've got a risk of, what's that, 55, and add another 5, so 60 pips, I'll look for a 120 point move. So there's plenty of room here to get that. As you can see, you would have even on the day here, you got over 200 points in this scenario here. So it all depends where you set your stop loss. Try to at least go for a minimum of 1-to-1. There is no rule of saying, yeah, to stretch this out or whatever it means. The way I look at it, any profit is a profit. You can, you know, move in 10 pips, 15 pips, close down half of your trade, move your stop loss to your entry price, and see what happens with the rest. Let's let it run until you're comfortable to exit it, or until, let's just say, it crosses the moving average 20 or the moving average 50. Any other questions, guys? All good? Trying to see what else I can show you guys on here. This is just the basics of trading of one indicator, which is the moving average. I'd say on average you should be right if you have correct entry and you follow some extent of trading, probably around that 65-68% right. That's if you were going to take every trade possible, which, like I said, it's probably not wise to do so. Now, usually when you see a huge spike through a moving average, I can tell you that the price most likely will reach and will go sideways and tend to smooth out and head the other way. Big rise usually means quite a bit of a drop straight away. And if you look at each dip, most likely most dips will equal on the next round up. So being like in here, which is about 50 pips, in a sense, most of the time you'll have another rise of about 50 as well. How long they fall for? Well, that's where the 200 moving average comes into play. You can see, obviously you can get a longer trend, longer term, and with moving averages, it's usually best to trade with the trend of the 200 or 233 moving average. You'll get most out of that. You can use that as support at some stages. If you put a small enough trade where you can hold off all these bumps, ups and downs, you'll be able to really get quite a lot of pips out of the whole trade. What else can we see here? As you can see here, this was a long trade. It dropped down and it continued again as a long trade. There could have been, like on this one here, there could have been quite a few opportunities. You would have gone in here, got out of the trade along here. You would have waited for another opportunity to basically come down about here, enter this, put your stop loss just slightly above here, and again write this down until it crossed over again. Then you'll see a bounce off the yellow, cross over the red, enter it again, and basically out here. Then for each time it breaks through the red, you could be entering and exit. So always take the trades in one direction. So if it's below the 200, for whatever color you might use, I've used blue, always take sell. Each bounce off, take a sell. Each bounce off, take a sell. Never try to trade against it by saying, oh, okay, it's dropped now I'm going to be buying up. Yes, you can make money, but at the same time, yes, you can also lose money. Like I said, a lot of traders use different styles of trading. You can trade with moving averages. You can trade with using RSI, stochastic, MACDs. The way I see it, the more indicators you put on, the more confusing you're going to get, because you're going to be waiting for an entry with, let's just say, moving average. Then you're waiting for the RSI to come into play. Then you're waiting for a stochastic to come into play. By the time all of them line up, the trade has already finished. So basically, find something that is simple, run a little bit of a back test, stick to the rules, and you should be good by all that. Any other questions, guys?
Yeah, Luke, after that, just when you're setting up a trade that's gone through the 200, how do you put it ahead of, like, you go past a zone? Is it easy to do on the Vertrader? I haven't done a executed trade like that.
You're saying setting up a trade for, sorry, what did you say?
Yeah, say where your arrow is there,
yep.
You want to set it up, all right, to reach that level, I want to set it up roughly there.
Yep.
Another 20 pips, whatever is down.
Mm-hmm.
So you can do an order to put it through at 126 ahead of the price.
Yep.
Is that right, on the MetaTrader?
Well, you could. I mean, I'm looking here at a history, so it's sort of a bit hard to imagine where this line's actually going to be. So it's easy enough for me to sort of say it. But if you wait at least for the one thing, you know that the price came, penetrated the 200 and reversed back. Now you just got to wait for the little bit of a confirmation of the lines to turn. Basically get that little turn on them, which happened as this price started closing down. You'll see the confirmation that everything is heading down. So yes, you can actually put on an order, let's just say below this one, because that's sort of like a slight support. If you were to draw a little support and resistance, it's, oops, get rid of that. there's a resistance here, and support here. So you could basically put on an order maybe 2-3 pips below this support resistance line here, and you could have just taken this trade all the way down as it went until it actually hit the moving average 20.
Yeah, otherwise it's going to be too late on the big move if you wait for it to happen.
Look, not really, because look, one way is this: you can draw your support and resistance lines way ahead of time, and that support resistance line stretches into the future basically. So this line would have already been here, showing you, which you could have put your sell stop here, a pending order. So as soon as you knew that, well, you didn't even have to know. As soon as the price came and penetrated this at one time, you would have entered your trade automatically. Do you get what I'm saying? I'll show you
I understand that. There's no problem. Just setting it up. I haven't done it on the move.
Setting it up. Look, something that I do to all of our clients and all of our new clients that come in, my role here is to obviously look after the clients, but also coach our clients to trade and make profits. And on a way of I do it is basically, if you were to, now this training is free, goes for about an hour and a half, and I basically teach you how to set up your charts, how to draw your resistance and support lines across the whole chart, and how to draw trend lines, support lines, and everything else. And basically, once you got it all set up, all you got to do is just, let's just say, look in your chart, and you'll know where the price is, where it might go, and you can apply using moving averages for your entries and exits. See, I show you here at the end of this chart. See what I mean? This line that was drawn there, I didn't even see any of this. As you can see, becomes resistance lines in here, support lines spot on here. Can you see what's happening? So it's like this is pre-done. And there'll be a lot more lines, and I'll show you exactly how to find those lines. How do you know whether it actually makes sense? See, like here, if I was to set up this, I would have done this a lot earlier. There's another one here. There's another one here. So you can look at the bounce off here. You know that there's a bounce off. You know it's above the moving average 200, and as soon as the line crosses, again, you could enter it here if you want to be really conservative and take that few pips here. But knowing that these lines already are above the moving average and are above here, on this entry here, you would have already entered it here. If you want to be conservative, you would have put a buy order right here above the resistant line, and that would be your entry point. So it's, instead of saying, okay, this price could have gone here and then turned back around, by having a support or resistance lines drawn way beforehand, which extend, as you can see, they extend into the future, you could have just put on the order here, a pending order, a buy order, and you could have just walked away from the computer. If it hits, it hits. Then put a, let's just say, target of either the next support resistance line or maybe 10, 15, 20 pips. Or you'd stay with it and until it closes below the moving average 20, which is basically, that isn't really closed, right here, early morning in Aussie time, obviously. Because these, those lines here, the white lines that you see, is the beginning of a day and end of a day, which is, I think, 8 o'clock in the morning till 8 o'clock in the morning. Does that make sense? when I trade, like I said, I don't use many indicators whatsoever. For me, it's more of a case of support, resistance, and trend lines. I'll show you some of my charts, the way I have set up in here. As you can see, let's just say Euro USD. There's all support, resistance lines, trend lines, squeeze outs. I know more or less where the price is going to bounce off. I mean, all those lines are drawn way earlier. So if I was going to do the, obviously I wouldn't short this, even though I knew it's going to bounce off here because I've attached the line here. I wouldn't have shorted it because it is obviously trending up. But if it gets here and it starts showing that it's going to go up, I'll buy it here and let it go up. That's why I said important to know your support resistance lines and where to put your trend lines. You know, here I've got an Aussie USD. You're only seeing, I don't know, 15 minutes, and I'll make this down. Look at all these yellow lines. This is all my support resistance lines. That might not be seen right now, but as soon as the price gets there, I know where this price is going to go. So here, it penetrated the resistance line here, went through it, broke a trend, will probably turn around, bounce off this line, and most likely, I'm not saying 100%, but most likely, will head towards here. That's its next resistance line here. Okay, because it clearly penetrated and went freely here. It had a bit of a bounce off of the longer term trend line. It didn't go and break through here, went up, now it's sort of turning around, and most likely it will go back up to here. Here's another one, New Zealand dollar, exactly the same. Look, when I make the chart smaller, you can see all my support resistance lines. I know more or less where the price is going to go from one point to the other. Way in the future. As you can see, they extend into the future. Basically, history repeats itself. Prices will go there one way or another. You know, gold, exactly the same thing. As you squeeze down the chart, there's more and more and more. And everything makes more sense that way. You know, this was a beautiful trade here that started actually just before this morning. A long-term trend line was broken. Actually, it's a pennant, the triangle here. The price got squeezed out, and it just went down. So I knew as soon as it broke through this trend line here, or this second trend line here, to this morning, right on here, to be conservative, I would have entered it right where it is right now. And I know my first take profit would be here, and we would have moved my stop loss here, and then let it go here. Okay. Actually, I was in and out of the office, and I think just my two small trades actually on gold here, as you can see. Those were just small trades. I wasn't really watching it, and I just left the office as soon as he went in, and I knew it's going to go in here. Came back in, just closed them. So there was two quick trades that I've taken this morning. So the importance of trading, guys, it's support, resistance. If you want to use for confirmations, you know, moving averages, RSI, stochastics, MACDs, that's good and proper too. I mean, I'll be going through most of the indicators that I would say 90% of traders use. But the way I look at it, you know, why is 90% of traders using those indicators, and why is 90% of the traders having the same results? Because in a sense, they work to an extent. It's better to be working with something that is not lagging and not ahead, because you're either going to miss or you're going to be way too early, and you might get stopped out because you jumped in too early. So by using something from a history that you can see this keeps on happening all the time, support, resistance, trend lines, you get clear. And then you can, if you really want to confirm yourself, you can overlay it with, where are we here? You know, moving average for that matter. Well, this is all up. Let me just change this moving average to to a different, to a 20, back in red. It shows you more clearly here. You know, you really tight, you would have entered it basically, you know, that the price already penetrated the moving average. The price penetrated the trend line. So it's a clear entry right here, or even up to close. So you would have entered it here. You know it's going to hit those few pips here. You know also it may or may not go to here. But if you look back, support, support, whole heap of support here, whole heap of support here, whole heap of support. So most likely the price aren't really going to stop here. It will continue to go here. If it breaks through, okay, you let it go. You close down half of your trade, move your stop loss to break even, let it hit here, penetrated it, quickly reverse. But you would have got quite a bit of a profit in here. Does that make sense?
Yeah. You split your orders when you put them on?
I do. If I'm going to be watching the trades or throughout the day, unfortunately for the Aussie time when I'm here in the office, there's not much opportunities usually in the morning unless there could be some kind of announcement. The market actually kicks in the guts probably, well, now it would. You got the UK Open, or it's be opening shortly. That's when you get the most volumes coming through and most movement. So I basically try to trade during the UK Open till maybe about 11 a.m. New York time. After that, the market just basically flats out. You won't get too many trades. I don't trade many currencies. My favorite is the Euro USD. You learn to understand the currency, you know how it reacts, and you know, Euro USD, Aussie USD. Sometimes I might use a New Zealand USD instead of Aussie USD, as the New Zealand one tend to go a little bit more, you get more out of it. Gold and USD yen. That's about all the pairs I use. But I can tell you that 90% of the time I'm just trading the Euro USD. Sorry about that, guys. The alarm went off. So that's sort of basically how I trade, but different people use different ways. So I thought I'll show you if I was to trade with using moving averages, this is exactly what I would do. I wouldn't use 2, I would use 3. In some cases, what happens is when you use 2, okay, let me get rid of the long-term one. Now, crossover, the 20 crossing over the 50, so you basically will be entering it here, and you put your stop loss either right there or right there, and you stay in until they cross over again, so you would have exited here. But now if you done a straight away a sell from here at this crossover, and then waited for a crossover here, that means you would have just copped a big loss. That's why I say have a third one there and only take the trades in the direction of the biggest trend. In other words, the blue 233 or 200 would have kept me out of this trade here. I could have re-entered at the crossover of those two. In other words, I'd come in here and I could have just, let's just say, take profit. I know that it's the second time now. I could take profit of 20 pips. Would have came in here and maybe I would have just jumped out here. Or I would have stayed in, then I would have seen a big spike. Usually when you see a big spike, you know what? You know it's going to quickly come down. I could have got out here. Worst case scenario, if I jumped in here, which is the crossover, let's be fair now, entries up this bar, so the next bar is this one actually down bar, and I would have exited at the crossover here, which is this bar here, I still would have made a profit. Not much, but there's like 9 pips. See what I mean by trading with the trend, not going against it? So like in here, I wouldn't have traded it down because that would be a loss. I would have waited for the positive crossovers. Again, in here, I could have jumped in here on that bar here. This one most likely would have probably, would have quickly turned around and exit me at maybe a slight loss, unless I did put the stop loss at the bottom of the low. Then I would have stayed in that trade. It will continue in until I either would have enough profit to jump out of this trade, or the trend completely changed. Does that make sense?
Yep. Do you use the Fibonacci target as well?
Yes, you can. Yes, you can. They tend to work pretty close to the support and resistance lines. Obviously, that's something that I'll touch on maybe next webinar or the webinar after. Don't want to sort of overwhelm each video with too much using different indicators, I suppose, what I'm trying to say. Just to give you an example, but I'll give you a quick example. I'll use it on the Euro USD. Now, I'll put it back on about an hour. And Fibonacci, where are we? Fibonacci. Top, bottom. Okay. They are the red lines. They go straight. As you can see, they are pretty well where I've got my support resistance. So one being here. There's another one in here, which is the 61.8. There's one at the 50, which I've got one pretty close to it here. There's a 38 here. I've got one a little bit lower. So as you can see, they all pretty close match up, but some of them I've got a little bit more, I suppose, closer to the feel of where the price is going to go than a Fibonacci. Fibonacci, you in many cases you will not get the whole response of the price actually hitting the Fibonacci. That's why usually if you're going to go from one Fibonacci point to another, like in this case here to here, you got to use about maybe 70 to 80% of it. In other words, enter here and exit here. Because sometimes, as you can see, even here, the price risen, it didn't quite hit it. So you got to sort of work out about the 80% to 75 to 80% range between a price. And that's when you're going to get actually most out of it. So yes, you can use Fibonacci, but I tend to stick to drawing my own support resistant lines and not really worry about the Fibonacci extensions at all. I'll just take this off. Like I said, I don't really use it. You can use it again, but that'll be something that I'll touch on another webinar, where I'll just go through all Fibonacci's, which levels are important, and so forth. That's sort of basically what I'm going to show you guys today. We can plan another one next week. If you guys got some ideas that you want to do something in particular, feel free just to either say it to me now or write it down in a chat, and I can prepare that. Alright guys, anyway, I thank you all for attending. This seminar was brought to you by FXTG Australia. And enjoy your evening or mornings, wherever you are. And I shall see you guys next Thursday. So thank you for coming and enjoy your day.